Hey guys, in this chapter, we're going to talk about some new types of accounts called sales returns, sales allowance, and sales discount accounts. So keep in mind as we're going over this, you need to know not only what they are, like what does that mean, but what type of accounts they are, how to actually record them in a transaction, and then which financial statement they show up on, and where and how. So I'm going to flip over to the document camera here, and I want to just remind you that the income statement, before I write this, tell me, what does the income statement show? So hopefully you said it shows the profitability of a company, and it consists of revenues, what the company has earned, minus expenses, the cost they've incurred in order to earn those revenues, and that equals the company's net income or net loss if revenues happen to be more, right? Okay, so we'll look at sales returns and sales allowances first. Even if you don't know anything about accounting, what does that mean to you? What is it, at least a sales return? So say you go to Target and you buy something, and then you decide to take that back later. When you first bought it, Target had a revenue, right? And then later, when you take it back, Target needs to reduce that revenue. If you took that pair of jeans you bought at Target back or whatever it was. So Target's revenue went up, and then it needed to go back down when you made the return. So we do this in accounting with a sales return account. So you know what it is now. The type of account, well, you think, well, we just reduce the revenue, right? So we've got this type of account called a contra revenue account. And we've talked about contra accounts before. Remember that word contra means to act the opposite of, contrary. So it's going to make revenue go down. So the type of account is a contra revenue account. How do we make the recording? Well, say on January 1st, Target made a sale of blue jeans, whatever it was, for $100. So Target would have recorded some cash, or maybe it was accounts receivable if you paid with your Target debit card. But remember, we always look at this from the point of view of the company. So the cash goes up by $40, and then Target had sales revenue of $40, right? So each of those accounts goes up. Keep your dealer chart out and handy if you need to do that. The reason we had a credit to the revenue account is because here's revenue over here on the right. That's how we increase it. The reason we had a debit to the cash account is because that's an asset, and it's over here on the left, or debit side. Okay, but then you, the customer, turn around and want to bring those jeans back. What happens? Like we said, well, you know Target's revenue needs to go back down, but instead of directly debiting the sales revenue account, we do so through this account called a sales return. So I'm going to write the entry, and then we'll talk about it. And suppose Target refunded your cash back. So this would be the entry that Target would make. Okay, now let's talk about why we debited the account called sales return rather than sales revenue. We know if we had debited revenue, that would make it go down because that's the opposite on the dealer chart. Well, we do so through this account, like I said, called a contra revenue account, mostly so that companies can keep track of all of their returns. If they just debited the revenue directly at the end of the year, it would be hard to look in that revenue account and see how much did we allow for returns. So this is really important, especially as the company gets larger, to keep track of. Are they allowing too many returns? Were there too many of this particular pair of jeans returned? Maybe Target needs to discuss this with their vendor. Maybe the jeans aren't a good quality, or maybe Target's policy is too lax. They let customers return things up to a year later, and now nobody wants that style of jeans. So keeping it in a contra revenue account right here, again, rather than just deducting revenue directly, allows Target to analyze this account at the end of the year. So how do we record it? That's recording it. Where do these accounts show up on the financial statement? Well, go back. Remember, I said the income statement is made up of revenues minus expenses, and that equals the net income. So a common mistake that some students make is that they think that sales returns accounts or these contra revenue accounts are an expense account. They're not an expense. They're just a reduction of the revenue. So what Target would record on its income statement is they would have revenues of $200, and then they would have less this contra revenue account called sales returns, and then they have something called net revenues, which if we're just looking at this one transaction would be zero. And then all their expenses would come out of that and they would get down to net income. So it's important that you can calculate net revenues. Hopefully by now you know the difference between gross and net. Gross is always the larger number, and the net number means it has been reduced by something. So seeing this placement on the income statement, you can answer the question of where do these accounts go in the financial statement? It goes on the income statement, but it goes in the revenue section, and it reduces revenue to get to net revenues, and then expenses come out of it. So what about a sales allowance? A sales allowance is also a contra revenue account, and sometimes companies give sales allowances just to reduce the price in something. Maybe Target price matches. If you bring in an ad from Walmart and say, hey, Walmart's selling the same pair of jeans for $30, and Target says, okay, we'll give you 30. They would record a sales allowance the same way. So in some companies, you just see this written on their financial statements as SR&A, sales returns and allowances. And again, they're both contra revenues that reduce the revenue account. So then we have another type of contra revenue account called a sales discount. A sales discount is when a company gives a discount to encourage payment faster. So a lot of wholesale companies issue their goods to the retailer that's going to sell them. So say Academy and Nike. Nike sends Academy a shipment of tennis shoes and says, hey, Academy, you've got 30 days to pay us for these tennis shoes. But then Nike decides, oh, we'd really like for them, that's our standard practice, we always give 30 days, but we'd really like for them to pay in 15 days, loosen up some cash for us, we need our cash flow to get going some. So we're going to give Academy an incentive to pay us earlier than we told them that they had to. So it doesn't mean Academy has to pay earlier, but if they decide to, they get an incentive. So I'm going to write down just a couple of examples to explain it, and then we'll talk about how to record it. So a sales discount, 210 net 30 is how you would read this. And what it means is this first one is the percentage of discount you get. This would be Nike saying to Academy, we'll give you a 2% discount if you pay your bill in 10 days, and then the net amount of your bill is due in 30 days. So maybe Academy can only pay half of the bill. They would get a 2% discount for the half they paid within the 10 days. And then the rest of the bill would be due in full with no discount in 30 days. There's no set formula or number of days this has to be here. This is just up to the company if they want to do this. Of course, they don't have to do this either. So you could, this could be anything. You could see 115 in 45. And so what does that mean? Test yourself and see. This would be a 1% discount if they paid in 15 days, or the net due in 45 days. So how do we record the journal entries for sales discounts? Well, again, on day one, we're looking at it from Nike's point of view, the company making the sale. They don't know if the vendor is going to take the discount or not. So the day they make the sale, say Nike sold $100,000 worth of goods to Academy on account. Nike would record, so day of sale, Nike would record accounts receivables of $100,000, and then they would record sales revenue of $100,000. So see, they don't record the discount just yet because they don't know if Academy is going to be taking that discount. So say on day 10, Academy pays them back. And this is going to be the terms that Nike issued to Academy. If you pay us back within 10 days, you get a 2% discount. So first of all, ask yourself, how much cash is Nike going to be receiving if Academy paid it back within the right amount of time? Does Academy owe the whole $100,000? And they don't, right? They get the 2% discount. So $100,000 times a 2% discount is $2,000. Now ask yourself, how much cash is Nike going to be receiving? They're just going to be receiving $98,000, right? So that is Nike's debit, cash of $98,000. Okay, what is our credit? So you ask yourself, from Nike's point of view, why did we get this cash? Did we earn more revenue? No, we didn't make another sale. We got this cash because Academy owed it to us. So we need to reduce this accounts receivable account. So here's a common mistake students make. They do credit the AR as they should. That's how we reduce an asset, is with a credit. But a common mistake is that students credit it for $98,000. And that's not enough, because look at the T account. This is why I say use T accounts all the time. From Nike's point of view, they increased their accounts receivable by $100,000, said, hey, Academy owes us this. And when Academy pays it off, if they only made a credit entry for $98,000, what would that show? That would show that Academy still owed them $2,000. And does Academy still owe them $2,000? No, they don't. Nike said, hey, if you pay us within 10 days, that's it, you get the discount. So right here, this entry needs to be a credit for $100,000 in order to show on Nike's books that Academy does not owe us anything now. So over here, our AR needs to be a credit for $100,000. But now look at that journal entry. Can I leave that journal entry like that? No, your debits always have to equal your credits. So I know that I need another $2,000 debit so that my total debits are $100,000 and my total credits are $100,000. What is that debit going to be recorded to? And this is your sales discount account. So again, looking at your dealer chart, on that first entry, revenue was a credit because revenue is over here on the right. And when we increase an account, that's what this chart represents. But since sales discount is a contra revenue account, it acts the opposite of revenues. So it's going to be a debit entry right here. So that's the journal entry. Now see if you can quiz yourself and tell me, what financial statement does this sales discount show up on? And then just as importantly, where on that financial statement? So for Nike, here's Nike's income statement. They had revenues of $100,000, sales discounts, and sales returns and allowances that we saw earlier in the video are all contra revenue accounts. So they act right here to reduce revenues. Again, the only reason we put them in these separate accounts here rather than just reducing revenues directly is so that the company like Nike or whomever can keep track of how much of a discount are we giving, how much are we having to accept in returns, and then what is this called on the income statement? What is this $98,000 number called? Called net revenues. So their gross revenues were $100,000, but their net revenues are only $98,000. And then Nike would go on to list all of their expenses. And then finally, we would get down to net income. So all three of those types of accounts are all contra revenue accounts. They all act the same, but sales discount is the one that you need to be careful when you're making the journal entry to receive the cash back, that you go ahead and wipe out all of that AR because your supplier is not going to owe you that money any longer.